Meanwhile, regulators and supervisors facing day 2 of congressional hearings on the collapse of SVB and Signature banks. And the chaos in the financials has some firms upping their odds of a recession. This week, Goldman pushed the probability back up to 35%. Joining us now, Charles Dallara, former Institute of International Finance CEO and Director at Large at the National Bureau of Economic Research, the firm that officially declares when we are in a recession. Charles, good to have you. Now, I know you can't speak in advance for NBER, but do you think we're heading for a recession?
Well, you're right, John. First, it's good to be with you this afternoon. And I can't speak officially. We have a special committee at the NBER that handles the determinations of when a recession arrives, if it does. My own view, however, is that events and the volatility and disruptions of the last few weeks have certainly increased the odds considerably of moving into a recession. Hopefully, and most likely, still a fairly mild recession in the U.S., but I do think the odds have grown significantly over the past few weeks. You know, in an environment like this, risk managers in financial institutions all over the country will go from risk on to risk off. The result is clearly a slowdown in the availability of credit to various sectors of the economy. This was already underway somewhat, John, but I think it will be intensified in the aftermath of the volatility of the last few weeks.
Okay, so we hear you say that. We see RH, Restoration Hardware, saying, boy, things don't look good for our guidance with luxury consumers. But at the same time, the Conference Board survey of consumer confidence shows people feel pretty good about what's going to happen 6 months from now. So another dislocation. What does that mean for stocks, for equities?
Well, maybe the average citizen has a better telescope out for the next 6 months than many of us do. But I think the reality is that, of course, stocks have gone through this major correction last year. And to a certain extent, I think they anticipated some of the volatility and stress that we've now seen in markets. But let's remind ourselves that, you know, we've gone through this period of stress precipitated in part by mismanagement of market risk by certain selected U.S. financial institutions. We have not yet seen the stress on credit risk that likely will emerge as we continue down this path of higher interest rates. We have not yet seen the Fed find its final resting spot here. And, you know, we've been through the most dramatic and rapid rise in interest rates in modern financial history, John. It's almost difficult to remind ourselves that just a little over a year ago, in fact, 1 year and 3 weeks ago, the Fed was still sitting on a Fed funds rate of 25 basis points. Yeah. Now we're at 5%. So the speed of that increase will still need to be processed through financial markets and through the credit availability of individual buyers and businesses.
And there's a lag effect to those rates, sure, but the labor market is still really tight. Real estate inventory is still really low. Unaffordability is still high. Prices still high. How many of those things have to shift in order for us to get that recession that you expect, and how quickly?
It's hard to say how many of those things have to shift. You know, we've seen recessions come through many different shapes and sizes in recent years. I mean, oftentimes, you know, recession can come fairly early in the cycle. Other times it can come fairly late in the cycle. I think the fact is, though, is that the system is still reacting to this dramatic reversal, not just in rates, but let's remember, we went through this extended period of quantitative easing. This fed a tremendous amount of liquidity in the markets. That quantitative easing has now reversed. We're in a period of quantitative contraction. So we not only have rising rates, but we have reduced liquidity in the markets. This is part of the reason why, in my view, the deposit base in certain financial institutions has been more unpredictable than usual. I do think that the tide is bound to turn here, John, and it's not at all clear when. Part of this depends in part on exactly when the Fed will determine that it can move into a pause. And I do think that given the strains in the financial system, that may be sooner rather than later now.
Okay, given that, if rates aren't going much higher, even if they do go a little higher, when's the last time we saw an opportunity like this to buy bonds with rates as high as they are, yields as high as they are?
Well, you've got an important factor, and certainly locking in some of those rates could be very attractive in the bond market. But let's face it, we've been through an extraordinary period of bond market volatility. And I'm not sure that investors are quite ready to have that much confidence in reduced volatility in the bond markets. Certainly, though, rates are looking very attractive if you're in a position to buy the bonds and hold them to maturity. Right. I think this is one of the key questions as we see banks struggling with these accounting issues of available for sale or hold to maturity. And that's an important decision which financial institutions and individual investors have to make.
Right, if you can afford to invest rather than trade. Charles, thank you. Great to have you. Charles Dallara.
It's a pleasure to be with you, John. Take care.